Everything around CRA gives them a lot of anxiety, emotion, uckiness around the taxes because so I owe $12,000. Now CRA is asking me to prepay.
A rental return is due on April 30th. It's not considered a small business. All of your rental income is also added to your income. I started my firms back in 1997. We have about 8,000 active clients Canadian. And we also do have probably about 2,500 US.
How many staff do you have?
Total of 9.
I'm the typical millennial or Generation Z individual that we wait to the last minute. Nadia, this is your second time on the podcast. The first time, all on me, I lost the file.
Oh, that was such a great interview, though. We have to try to recreate it.
We have to, absolutely. It was a good hour and a half of you talking about your journey. This podcast is going to be a little different where it is tax time. And there's a lot of people that do not know where to go to file their taxes, what to prepare for. Everything around CRA gives them a lot of anxiety, emotion, uckiness around the taxes because it's a lot. There's a lot of slips that come in the mail or on file. There's a lot of deductions that need to happen. Accountants are busy. There's so much that goes into it. But before we get into that, who are you? What's your company? Let's talk a little bit about you before we dive into what would be beneficial to a client.
Okay, cool. Well, I'm Nadia, born and raised in Thunder Bay, and now I actually operate 2 tax firms, one in Thunder Bay, one in Ottawa. huntclubtax.ca is our Ottawa-based location, and that's also the location that accepts our online folks. So people that they don't want to go to a tax office, but they want to deal with someone completely online. So
how long have you been doing taxes for?
Oh my, I started my firms back in 1997. Signature Financial in Thunder Bay was my first one. And since then, I have acquired 4 other accounting firms, including yours.
And how was that process?
Acquiring the firm?
And I guess how many clients have you acquired during that process? How many returns have you done? How many staff members do you
Oh
have?
man. Yeah. Okay. So this is great. So right now, I would say between all of the firms, we have about 8,000 active clients Canadian. And we also do have probably about 2,500 US. We have a US branch that files US tax returns as well. And that's been kind of a gradual increase as I've bought firms over the years, as I've gotten my own clients, referrals, all that kind of thing. So it's a mix of both.
And how do you do 8,000 returns a year? How many staff do you have?
Total of 9 between the 2 firms. And bulk of the returns are done this time of year. So February 23rd is when tax season opened this year, which is consistent. CRA usually opens taxes at the end of February, and then the due date is April 30th. Small business owners have till June 15th. So this time of year is when we do the bulk of them. Through the rest of the year, we do get the people who haven't filed, or they're filing a bit late, or they've had some circumstance where they couldn't get in on time. So we probably do, let's say, 2,000 returns not in tax season. Generally speaking, we sort of cease all of our corporate work and we start extending our hours. Everyone likes to work a bit of overtime so they can have some free time off later on in the year. Yeah, we just make it happen.
Everyone talks about April 30th. What is that date?
That is the due date for tax returns to be filed by individuals in Canada. And it's also the due date for any tax owing that needs to be paid.
So if you're a sole proprietor, what does that mean for you?
It means that you do have until June 15th to file your return, but if you owe any taxes, you're expected to have those paid by April 30th.
So if you don't do your taxes, if you don't do your taxes till May 15th, how do you know how much you owe to CRA?
You don't really, but the CRA depends on you to make an estimate. And if you can't get your tax return prepared, you should at least make an installment payment to mitigate some of that.
And would you go on previous year, or how would you make that estimate?
Could definitely go on previous year, or if you have a sense of how well your business did, like generally business owners know how much profit they've made, we can do a very rough calculation.
And you're taxed on the profit. What is a profit?
The profit is what is left after all of your expenses. So your sales is your revenue. Everything you purchase in order to run your business would be an expense. And the difference between those two is what you're taxed on in very simple terms.
And is it a variable tax, or how would you make that estimate? Let's say I made $100,000 net.
Mhm.
How would I know how much I would calculate?
Yeah, in Canada, there's two sort of ways you can figure that out. One is your federal tax rate, and then depending on which province you live in, there's also a provincial tax rate. Canada.ca has a section called All Rates, and if you plug in your income, it will give you that rough calculation.
Okay, so you can go on, it's canada.ca,
Mhm.
and you can do the calculation yourself
Yeah.
if a tax preparer is not available.
Yes.
Now, what happens if you have extra slips, like a T4 slip or extra slips? How does that
Mhm.
all get calculated?
All of that gets calculated as part of your income. So whether it's employment income, business income, rental income, investment income, it all gets your pension income, it all gets totaled together. And that ultimately determines your taxable income figure.
So when we talked about a sole proprietor netting or a profit $100,000, that's solely them having one source of income.
That's right.
But if they worked in the government and had extra income, how would you do that calculation?
So you would take that employment income, add it to the business income. That would generally
Yeah.
help determine what their taxable income would be.
But
There
you
are some deductions from that, like RSP contributions, any CPP you don't get taxed on. So there's a few deductions from that, but ultimately that's what helps us determine your taxable income.
and what happens if I do not make the payment by April 30th if I was a sole proprietor?
The CRA will impose penalties and interest for late filings.
And are those interests high, low?
They can be. The CRA changes their interest rates every quarter. The one in the quarter we're in right now, which is quarter two of 2026, is 7% interest, annual interest on any outstanding taxes.
Wow. So if you're not making the payment, you're getting charged 7% on that amount owing to
That's right.
CRA. From an individual perspective, what happens if you file May 1st?
Well, your tax return would be considered late. And if you have anything owing at that time, that would be subject to penalties and interest. If you're in a refund position, there's no interest charged by CRA.
And when do you accept clients until April 30th, or do you have a capacity limit, or does accountants have a capacity limit?
I think we all have capacity limits. We accept clients anytime. You can come in anytime the office is open or submit the return online anytime. We guarantee filing by April 30th if your return is into our office by April 15th.
What makes you different than other accounting firms, and how are you able to handle 6,000 clients in such a short period of time?
Well, we have a lot of streamlined processes. We rely on technology a lot. I have a really amazing workflow manager and a solid admin team. So all of us work together. It's not just me, it's the entire team and our technology that we've developed.
And let's say I'm a client. What do you have a location, or how does it work? What's the process
Yeah,
flow?
in Ottawa, our location is 1183 Hunt Club Road. And in Thunder Bay, our location is 125 North Cumberland Street.
And so I would come in there and print off all my stuff, or how would I go about this?
Anything you've received in the mail, we'd love to have those physical copies. We'll get you to authorize us on your CRA account, and we can also cross check there to see if the CRA has any slips filed that maybe didn't come to you in the mail.
When you talk about CRA authorization, what does that mean?
The CRA authorization is something that you set, and it allows the CRA to speak to a representative on your behalf.
And do I have to have online access, or what's the process with that?
The CRA and our firm also is recommending that every Canadian has a My CRA account with an active password and the ability for you to log in. Gives you insight into anything that's outstanding, the tax returns that you filed, if you have an amount owing to CRA, and it's really the most secure way to communicate with the CRA regarding your tax file. Also has the most accurate information.
So what happens if I don't have a CRA account?
If you don't have a CRA account, you can bring us your last notice of assessment and you can sign a form that allows our firm to have access to your account.
Okay, so two options. I either have CRA access, which I can give you, or bring a notice of assessment of 2024 that you can bring into the office.
That's right.
Is that across the board to any accounts right now?
Yeah. Yeah. The CRA has mandated a lot of increased security this year.
And how's that working for your current clients?
It's great. Yeah. I think the clients feel that they can have visibility into their own tax affairs, which I love. I love clients who are feeling informed and empowered.
Because it must also give them the ability to get notifications from CRA, them check
Absolutely.
it themselves, have more power
They
in
can
their
see if there's
tax.
anything owing. They can see if the return was filed on time, if it was filed correctly. Yep.
So do you help set people up with that?
Yeah, we sure do. If the technology is feeling overwhelming, we can definitely have someone in the office on an appointment basis and help them get set up with their CRA account. What they need to do that is their notice of assessment, like I mentioned. They also need their photo ID, and then they use like a link. Get a picture of their ID and a selfie, and then they can have instant access.
What are current deductions that people should be aware of this tax season? You talked about RSP contribution. What else should we think about?
Yeah, RSP contributions are a great way to save money and also reduce the current year tax burden. Tuition is definitely one, both for the student themselves, and they can also transfer any extra tuition over some extra tuition to a parent or grandparent. Medical receipts, as long as they're more than 3% of your income, will qualify as a income tax deduction. Donation receipts also are a great way to support causes that you believe in and get a tax break for that as well.
Do I have to bring in the physical receipts or can I have the total numbers or how does that work?
I mean, to communicate with our office, we're happy to take those total numbers. However, if the CRA ever asks for them, you want to make sure you have the proper receipts on hand.
What, any other deductions?
If you have investment income, you can deduct the management fees that you pay and your accounting fees.
And I'm getting T5 slips in the mail. What does CRA have access versus what um I have to also bring into to the office?
Any T slip that you receive in the mail, that organization that issued that T slip also has to issue a copy to CRA. We assume that if you've received a T slip, CRA also has a copy.
So I could just store those T slips in a folder,
Yeah.
knowing the fact that CRA has access to the T slips. If I wanted to cross reference what has been submitted to CRA, what would I do?
You'd want to take the physical T slips that you've received, either from your employer, your bank, or wherever you've received them from, log into your MyCRA account, and make sure that everything that you've received is also reflected online.
Okay, so we have April 30th for an individual. What classifies as an individual?
As someone who has income that is not small business income,
So if you're a T4 slip, employment, you're working for someone,
you have pension income.
pension income,
Yeah.
that tax return is due April 30th.
Yes.
If you're a small business owner,
You're
not incorporated, you're due June 15th.
correct.
Um, what happens if so are you handling any small business owners or
Oh, yeah.
is it usually after tax season?
No, we do them as they come in.
And what would they need to bring in for you?
So, in addition to all of their T slips, donations, medical receipts, they would also need to provide us details of their business income. How much did they charge their customers, which would represent the revenue that they've earned, and then anything they paid to operate that business. This could be supplies, meals and entertainment expenses, utilities or phone bills, office expenses, any licenses or dues that they've paid in order to operate that business. They would also want to provide us details if they've used their vehicle. Also, a small business owner can expense a portion of their home office if they've run the business out of their home.
If I work from home, can I deduct my home office as an expense as well? Explain that.
Like if you're an employee and you
Yeah.
work from home, if your employer provides what's called a T2200 form, they will detail out that they require you to work from home and whether or not they've provided you any reimbursement. With that form and the associated home office expenses, we can claim those amounts against your employment
Okay.
income.
So if I work from home, I have to reach out to my employer to get a
Yeah.
T2200 signed. And then I would also give you the signed copy plus all my home office
That's
expenses.
right. We'd also need to figure out how much of your home is used. We calculate that based on the square footage.
And what are the expenses in a home that I would be able to claim?
You can claim your utilities like your heat, electricity. You can claim your home insurance, the interest that you pay on your mortgage, your property taxes or condo strata fees, or if you've paid rent.
And what does that do for the overall tax strategy?
Yeah, what it does is it creates a lower taxable income. So ultimately, that will create a deduction where you pay less tax on the income.
So give me an example of that.
Let's say you make $100,000 and you work for an employer who's provided you a T2200. And the employer notes on that T2200 that they require you to work from home and also to pay for your own cell phone. And they don't give you any reimbursement. We would be able to deduct the amount you paid for your cell phone and let's say 10% of your home office expenses if you're using a bedroom in your house. Let's say those expenses total $2,000. Now, instead of being taxed on $100,000, you're taxed on $98,000.
Right.
So
So it,
ultimately, less tax dollars.
right. So do a lot of people claim their home office or kind of just forget about it?
Yeah, I think since the pandemic, there's been more people who have found success working at home and more employers willing to provide the T2200 to do so.
So um I'm just kind of fire chatting a lot of
That's
questions
fine.
to
Yeah, ask
you.
anything.
um I'm just thinking of that 30-year-old individual that is working for someone. So let's say I'm employed but also have a side gig.
Oh, yeah.
What happens there?
So we would have your employment T4, and we would also want the information from your side gig, or as we like to call it, your sole proprietorship. Those two sources of income get added together and ultimately will impact your taxable income.
And when's my taxes due in that situation?
April 30th.
Okay. So April 30th
Yeah.
because it's still categorizes as a individual filer.
Sorry, your tax return is due June 15th.
Okay.
So is your spouse's.
Okay.
But any taxes that you owe are due April 30th.
Okay.
Tax payment is always due April 30th.
So if I have any sole proprietor taxes,
Yep.
plus I'm working for someone, my deadline is June 15th
To file.
to
And
file.
same with your spouse.
And same with my spouse.
Yeah.
So there's an extension there.
Yeah.
And do I have to say anything to CRA, or if this is the first year,
No,
they just
they know.
they know based on the business return that I'm filing?
That's right. There's a separate schedule within your personal tax return that signals to them that you also have a small business in addition to your employment income.
And then how does that affect my spouse too?
Well, generally speaking, when a married couple files, we want them to file together. It doesn't make sense for one return to be due on June 15th and one return to be due on April 30th when they have to file together. The point of being able to file June 15th is to give small business owners a bit of extra time to get their returns prepared.
Do you like filing them together?
I do.
Why?
When we file a married couple or common law couples returns together, there's less of a chance of anything being missed from one return to the other. Any credits that might transfer from one return to the other will be done at the time of prepared. There are some couples who like to get their returns done in advance. And if there is any changes, the CRA will reassess them.
And what is a credit that they both can be applied to?
Medical receipts and donations are a common one. Tuition transfers from a child are another common one. And that can depend on the income of one spouse or the other. So when we file one spouse alone with the medical and donation credits, then the second spouse comes around later. It might have been beneficial to transfer those credits over.
Why? Is it based on income? Is it
Yeah,
based on a higher income?
it's
Like,
based on the way that the income from each spouse is calculated.
okay. So having the full picture gives you a better ability to determine
Yeah.
who gets the deduction or
Yeah.
not.
And when spouses are collecting pension, that pension income can be split. And we always try to optimize that so that the couple has a lower refund. And we can't do that unless we have both returns.
Right.
So we like to file them together.
And then once the return is filed or prepared, do you speak with the client to be like, if I'm missing anything, or how does as
Yeah.
that conversation goes?
One of the practices that we have in place at our firm is we always try to look back at previous returns just to make sure that there's no wild variances and things. I had one today actually where a gentleman's employment income almost tripled. So I absolutely got him on the phone and said, "Hey, this is what I'm seeing," just to make sure that his expectations of what his tax return are going to be line up.
Because his taxes tripled as well, or could
Oh, they sure did. Yep.
right.
Higher income, higher taxes. Yeah.
So talk about the variable tax rates we have in Canada.
hmm
So yeah, what is a variable tax rate?
It just means that depending on the income level you are at, you will have a different tax percentage. And it can get quite high. High income earners are at the 49% tax bracket, right? So a lower income earner might be paying 16, 17% tax versus a high income earner. And sometimes what happens is people that are variable, real estate agents, commission salespeople, they will experience their increased income through the year, but then not realize 4 months later that they have a big tax bill and they should plan for that.
And I guess the question too is, okay, so let's say I'm making $60,000 a year and I just got a raise of 15,000. So now I'm up to 75,000. Would that put, depending on my tax bracket, but would that push me to a different tax bracket potentially?
Yeah. And if it's all employment income, the responsibility does somewhat lie on your employer to make sure they've adjusted your tax deductions off of your paychecks accordingly.
Mm.
When something like that happens, it's a great idea to call your tax preparer, and we can also project that out. So let's say you get this raise in July. I would love a phone call or an email so that I can run a scenario to make sure there's no surprises in April.
So does that also mean if I have $100,000 in employment income and I just started a sole proprietor side gig and I made an extra 20,000,
Yeah.
is that 20,000 added on top of my 100,000 or is that starting from scratch?
No, that's added on top of your 100,000. And unlike your employer, you're probably not taking any tax deductions off of that. And sometimes that results in an unexpected tax bill on April 30th.
Right. So what's the best way to track that?
What I like to suggest for my self-employed folks is that if you're running a sole proprietorship, you take 30% of that income, either pay it as an installment payment or at least set it aside so that we're ready for April 30th.
What's an installment payment?
An installment is a prepayment on your personal income taxes that you make to the CRA.
Why would you do that?
You do that so that you can smooth out your cash flow through the year and not have a big bill due on April 30th.
A lot of people I talk to are now receiving installment notices for the next year. What is that?
Absolutely. If you owe more than $3,000 on April 30th, the CRA will request installment payments in advance of the next tax year.
And what happens if you don't pay them?
You get charged installment interest.
And what is that at?
Right now, the interest rate changes every quarter. Right now, it's at 7%.
So I just finished my 2025 taxes.
You did?
It
Are you filed?
no, I'm not actually.
I
If-
can't be friends with a non-filer.
I have 22 days. So I'm the typical millennial or Generation Z individual that we wait to the last minute. I'm stereotyping a little bit, but um, I just, let's say, filed my 2025 taxes.
hmm
And now I owe $10,000, $12,000 to the government.
Okay.
I didn't make installment payments for last year,
Mm.
so I owe $12,000. Now CRA is asking me to prepay 2026 for 2027, so I'll also get an installment voucher or
Yeah.
whatnot in the mail for $3,000 every quarter.
Correct. Yeah. They want the money that you were supposed to have paid through the year, and they want next year's money.
And are you seeing people pay those installment payments or kind of wait till the end? Like what's the word on the street with all that?
There's kind of two groups of people. There's some people who really don't want any ripples at all with the CRA, and they're happy to pay their installment payments so that they know that they're ahead of the game. The other group of people says they can make more money investing that into their business or an investment than they're willing to pay the 7% interest to CRA.
So that's not mandatory to do, but interest gets charged to it, or is it mandatory? It can be a
The CRA the CRA's position on this is that installment payments are mandatory.
okay.
I
So
think
that's
what
the
they've
politically right answer
For sure. I think what they've decided to do is not be punitive with it.
then.
So
Right.
they're not penalizing it. They're just applying installment interest.
Gotcha. Um, okay, so when we go back to the employment and side gig or sole proprietor, that extra 30% you're allocating to a bank account or paying installments, that will help the employer's taking off the taxes here.
Yeah.
You're confirming that. So that's a check for the client,
Yeah.
the individual to confirm that the employer is taking enough taxes if you do get a raise.
Yeah.
And it's different than the year prior. Like the example you gave of the individual 3xing their income,
Mhm.
did they call their did the employer take enough taxes for that person?
They didn't know because the income was a combination of employment income and self-employment income.
Okay.
So the self-employment income portion had no taxes taken off, and the employment portion had sufficient taxes taken off for that employment income without taking enough off to encompass all of the income.
So
You can request your employer to deduct more tax if it's easier just to have it done off your paycheck.
so would you recommend if a sole proprietor is making money
Mhm.
and extra income to report it to your employer so that they can now take off more taxes for you? Or would you keep them separate?
Um, I would actually just take the self-employed income and make a tax installment payment or set that tax money aside.
But how do you know it would be 30% or higher? Like, let's say I'm making $150,000 as an employment income. It'd be higher than 30%.
It would be
Right.
35%, right? And these are good conversations to have with your accountant outside of tax season so that we can help with those determinations.
So, what would be a scenario for these individuals to come in July, August? Like, when do you guys
Yeah,
do that?
we love meeting with clients before the end of the year when we can actually start reacting. So, any time between July and October, especially if you've had some significant income swings, is a great time to come and meet so that we can do what's called a tax planner. And what we do there is we just try to project your income to the end of the year. And we use last year's tax rates as a, a way to estimate what you would owe. And then at least you'll know, okay, I owe X dollars. I'm going to owe X dollars at tax time. You can have that set aside or you can make that installment payment.
And when you talk about this quarter, the installment interest is 7%. Does it vary quarter by quarter?
Yeah, the CRA releases interest rates on a quarterly basis. They
Okay.
just did the ones for April 1st. Canada.ca in the all rates section will have those.
And is it dependent on what the economy is doing? Is that how they determine the rates?
Yeah, it's set by the Canada Revenue Agency.
Okay.
Yeah.
So it changes every quarter,
It
up
can
or
change
down.
every quarter.
It
Yeah.
can change every quarter. From your experience, is it consistent throughout the years? Is it mm,
I haven't seen a lot of variable years since the pandemic.
right?
They did reduce them quite a bit during that time. I haven't seen a lot of variability.
So we talked about individuals, we talked about married couples, we talked about sole proprietors just running a small business. We talked about employment plus sole proprietors. What else?
There's really unique tax requirements that happen when someone passes away.
Okay.
One of the things that the Canada Revenue Agency does is they release what's called a death benefit, and it's a $2,500 payment. This gets confusing for people because a lot of people think it should go on that deceased person's final return. In reality, because a deceased person can't earn any money, it needs to go in one of two places. One place, and the most common place for it to go, is on the executor's tax return. So whoever's in charge of managing the estate needs to report that $2,500 on their own tax return. In the situation where the executor can't or is unwilling to, we need to do something called a T3 trust return for that benefit. This gets complicated and confusing for people who are already dealing with a lot when trying to manage an estate.
Hmm. So what would you recommend in that scenario?
The easiest way, if the only income after death is that death benefit, The easiest way is to report it on the return of the executor. If the estate continues to make income after death, perhaps there's a rental property or some investments where a T3 return is required anyway, we would put that death benefit on the T3 return.
Gotcha. And then the last thing that's on my mind, anything else in regards to that? That's a great point. So one thing that just came to my mind is rentals.
Mhm.
So how does that work and when are they due as well?
A rental return is due on April 30th. It's not considered a small business. All of your rental income is also added to your income. Again, we can deduct anything that is paid out in order to manage that property, like the insurance, the property taxes, and any mortgage interest, any repairs and maintenance, or any other expenses that are required in order to generate that rental income. Rental income, the property itself, if that is ever sold, is also subject to capital gains. Unlike where we live, which is our primary residence. If we sell our primary residence, there is no tax implication. We have to report it, but we don't pay tax on that. We do pay taxes if we sell a rental property for a profit.
What is a capital gain?
Capital gain is the difference between the cost of a capital item, like a house, and the price we sold it for. The difference between those two is a capital gain. And in Canada, we are taxed on half of our capital gains.
So let's say the property's worth $1 million and I bought it for 500,000.
So you've bought a property for 500,000 and you've sold it for a million. You have a $500,000 gain. You would be taxed on half of that gain
So 250,000 would be reported on my tax return
as a capital gain.
as a capital gain. If I'm not making any money, that 250,000 would be a variable rate,
You would be taxed quite high at that, yes.
right? But if I'm also making extra money, would it be on top of that income?
Correct.
So when do you recommend people potentially selling their rental properties?
Well, the tax rate in Canada is never 100%. If you can sell a property for a profit and that's something that is going to suit your personal desires, your family situation, or your financial situation, definitely go and sell the property. Just make sure that you've planned for the tax you're going to have to pay on that.
Right.
And again, that's a great opportunity to reach out to your accountant and say, hey, I've had this rental property. I have an opportunity to sell it for this much. What will my approximate tax implication be? And we can help calculate that so that you can hold that money from the sale aside until April 30th.
So if I sold something in 2026, I have to pay that in 2027?
That's right. It would be reported on your 2026 tax return, which is due next April.
Right. And what is depreciation of a property?
The depreciation of a property is a way of expensing the property over time, over the use of a property. Take something like a house. Obviously, the house is going to last longer than 1 year. We can't expense the purchase of a house all in 1 year. Same thing if we make a major improvement. We put a new roof on, or we put a bunch of windows in. Those have lasting value. So the CRA doesn't allow us to expense that all in 1 year. It has to be depreciated over time.
And when we talk about a capital expenditure, so let's say I get a roof done and it costs $20,000.
Yeah, that's considered a capital expenditure. It's physically attached to your building and it has lasting value and it was a significant price.
So you wouldn't claim all of that as an expense the first year, which means let's say you're making $24,000 and $2,000 a month in rent, $24,000 for the whole year. And let's say your expenses are $4,000 for simple math. Your profit on that rental property is $20,000,
That's right.
right? And that $20,000 is then added to your employment income or any additional income.
That's right.
If I had a capital expenditure of $20,000, you wouldn't lower the $20,000 of income to zero.
No, a true capital expenditure cannot be used all in 1 year.
So it would be over time where it's now reducing that income for the next 5, 10 years.
However long the
However,
asset is in use. Yes.
and with depreciation is what's so the flip side of capital expenditure, you can also depreciate your building.
Yeah. So the depreciation is a way of expensing a tiny piece of your capital item every year.
And could you depreciate your property as well?
You can depreciate the actual building. Land is never subject to depreciation.
Why would someone depreciate their building?
They would depreciate their building to take tax advantage of the cost of that building over time, small amounts each year.
So if the profit is $20,000, you can also depreciate your building, lower the profit.
That's right.
But what's the contra effect of that?
Well, the contra effect is that when you go and sell that property, you're going to have a higher gain. So even though, again, using some round numbers, let's say you bought a building for $100,000 and it's been depreciated 4% per year. Now, 2 years later, you go and sell that building. Well, you've depreciated it $8,000. So now the gain is not between 100,000 and the selling price, it's between 92,000 and the selling price. So you'd have a higher capital gain. It's just a way of shifting the tax burden from the time you sell it to the time that it is in use.
And this is something that you would have a scenario with the client and you would see what numbers make sense,
Yeah.
and it'd be a pre-planning thing.
Yeah, and we want to talk a little bit about what is the long-term plan with the property. Some people are like, I'm going to sell this in 2 years. We would take a look at what the different scenarios would be. Some people will say, I'm going to keep this and leave it to my children. That's a completely different tax scenario, and it's all individual.
Right. Well, those are all the questions I have.
Great.
Did I miss anything?
Probably.
You did really well.
Absolutely.
Yeah. Thank you for answering all those questions.
Good.
Share this with a friend so that they could be a part of this journey too. Keep watching for more.